The sell-off in bonds, it's happening globally, not just in the United States. We've got the backup in yields here and in the UK and in Germany. One bond manager has talked about the bond bear market beginning. Do you agree?
Well, I think it could be a bond bear market, but it's going to be more, I think, a teddy bear market than a grizzly bear market, because the same things that have supported low bond yields here and throughout the world, which is largely monetary policies, have also supported the equity market. And so at some point, when bond yields get up to, I don't know, 285, perhaps they'll get to 3% in the 10-year area. I don't think so, but they might. Then I think the equity market is going to pick up and take some notice, and I think it's going to be to the benefit of the bond market.
So you could have, so in other words, the causation could go, bond market yields go up, that feeds through to equity market volatility, and then amidst that equity volatility, people are like, oh, got to buy some bonds.
Exactly so. And, you think about the weightings and how an equity portfolio, so, a balanced portfolio a year ago, now is overweighted, relatively speaking, in equities. Right. And so if you get bond yields a bit higher, that suddenly they're attractive.
So, David, also talk to us about the level of supply, because there's been a lot of talk about the fact that we're going to see double the supply in 2018 that we saw in 2017. And just the optics of that, to me, in line with greater spending from the federal government in the United States as a result of what we've got as far as tax reform is concerned. Perhaps you've got some corporates as well that will look to sell some of their holdings if they want to do greater spending. There feels like a convolution of factors here that could mean higher yields. What are we missing?
Well, I don't think we're missing anything on it, but yields are higher because we've known that this was coming for a long time. Obviously, the tax reform has added to it, but that's been talked about since the start of the Trump administration. And if you look at the nature of the deficit, excluding the tax stuff, economists and others have been forecasting this for years. So it's not really new news. It is on us now, and I think that's enough to justify somewhat higher yields. But when you have that much issuance out there, it is taking capital away from other areas, from other investments. And so there is going to be some forced demand. You have to remember that if you're in a bond index, for example, you're looking at an aggregate index, you're a bond manager, you're a passive investor, as more treasuries come into the marketplace, your benchmark is going to have more treasuries, and so you're sort of forced to at least do some buying to sort of maintain pace with the issuance and what's going to be happening there. So there is a bit of a forced buying need. I don't want to make this out to be like it's a bullish case, but I do think that there's a backstop.